Today, we are going to be covering one of the hottest investment strategies in today's market, and that is oil and gas. So, Steve is a wealth of knowledge. He has over 20 years of experience in the oil and gas field, actually operating businesses that did this work. So, he is a wealth of knowledge, super informational, and really just takes a great approach at helping people understand the good and the bad, the pros and the cons, and if oil and gas is an investment strategy that should fit inside your portfolio. So if this is the type of content you're looking for and you haven't already, hit that subscribe button. We've got more great shows to come. And if you are needing help reviewing some documentation and don't want to pay an attorney, download my how to use ChatGPT for due diligence guide in the description below. And let's hop into getting information from Steve right now. Okay. Hey, Steve, thanks for being here. Glad to have you on the show. And man, let's just start out with introducing yourself, and let's give our listeners kind of maybe the origin story of Steve Blackwell, and what your history looks like. I saw I've known you for a while. I did a little bit of my own research, and I was like, you have a long history of really high level leadership. So would love to touch on that, and then how that led into what you're currently doing.
Yeah, great. Well, it's good to see you. Glad to talk. Look, my background is, well, first, Steve Blackwell, currently the CEO and co-founder of Vito Energy Partners. But my background, I guess, I'm 56 at this point, so I guess it's kind of long. I'm originally from the Midwest, live in Texas now, but, got a degree in finance and accounting out of Central Michigan University, got my first job, into the mortgage banking world is where I spent my first 16 years of my career. And really my trajectory there was, I got my first management job. I managed my first branch by the time I was 24. So I got into management really quick, and I was in a larger company. So I got a lot of really good training on management. And from there, I just was managing. I managed a branch, in my hometown. And then I moved up to Detroit to a bigger branch. Then I got recruited to another company to move to Denver and to open a division for them of their wholesale division. And so I moved to Denver, trying to keep track of my years. So that was 1996.
Okay.
That's how old I am. So 96, I moved to Denver from Michigan, opened up an office there for a company. And that eventually led to me being a regional manager. And I was over about 13 states there. And that company eventually got bought, and they closed our division. And I went to another company and started off as a regional manager, and eventually I became the senior vice president, divisional manager for that particular company. And at that point, I had about 13 or 14 states in the Western United States.
And so all this was finance and banking related so far?
This was all mortgage banking. So I was
mortgage banking.
And had offices in Seattle, Portland, Orange County, Dallas. And so I would travel around, had salespeople in all of those particular areas. We had centers, so we had processing centers. And so just been in management my whole career, and then I got recruited from that particular company to move to Dallas, and I took over basically all of subprime wholesale lending at that point on the sales side for Countrywide. So that's what brought me to Texas. So I, 30 years old at the time, had about 3,000 people under me, had a really great career going in that space. Countrywide was a large company, the largest I ever worked for. And quite frankly, didn't enjoy it at all. I'm not really a big corporate guy. And so after 2 years, I left and had a great job making a ton of money, but did not enjoy large corporate America. Large corporate America is about managing up. So, yeah. And I'm not a politically correct guy inside of an organization.
Yeah. I've been self-employed for almost a decade, worked for small businesses before that. And what I hear my friends talk about who work for the large corporate entities, it would make me bang my head against the wall.
Some guys or some people really thrive in that environment and do really well. And I'll be honest, it's politics. It's managing up. You have to be really skilled at managing up, and to be skilled at that, you have to enjoy it. And it's just counter to my nature to say what people just want to hear versus what I think to be true. And so this just wasn't my fit. And I left there and went to another firm as basically the COO. And it was a nationwide firm, but it was a smaller company. Great job. Loved it there. And then the 2008 financial crisis came along. And so
Yep.
at the age of 36, I woke up and had lost my entire career.
Oh
So
man.
pretty brutal life transition because I had spent my entire career in the subprime lending space, and it was gone. Essentially, within 2 years, it was gone. And the ABS MBS market for those that type of collateralized loans basically disappeared. It's back, came back maybe 5 years later, but
Mhm.
essentially what my career was gone, and it was really difficult to even get a job in that space. So I spent like 2 years doing some consulting work, and I was in line for a couple jobs actually, a CEO of a structured settlement company, and then
Mhm.
a COO of an auction house. And both of those jobs fell through at the same time within the same like 2 days.
Oh man.
And they actually chose the CEO job. Chose my Came down to me and my former boss at Countrywide. They chose her. Uh, I think she's still there, by the way. So it's been a while. But then I went to church with a gentleman who was one of three owners of an oil and gas company here in Dallas,
Okay.
and he's one of the elders of our church, and we become friends. And we would go to lunch. He'd ask me to lunch and ask me a lot of questions just about managing. They were three entrepreneurs. Their skill sets was not professional management. Quite frankly, none of them had ever worked inside corporate America.
Yep.
So they
They're
kept
probably all three unemployable in a traditional sense of the word.
100%. They could
Yeah.
never work for somebody. And so he kept asking me to come help, and I just kept denying it, saying no. I don't. At that time, I literally my experience in oil and gas was filling my gas tank, and so eventually, I just said after those two jobs fell through, I said let me come in, see what I can do. My background's finance and accounting. I know how to run
Mhm.
businesses. I know the financial side of the business. I know how to scale, organize businesses, and let me see what I can do. Um, and long story short, within a year, I was the president of the company. And over the next 8 years there, we did five assets, three of them
Mhm.
operated, three operated projects that it covered about 80,000 net mineral acres. And we spent about 350 million on those projects and exited out for, almost 900 million. And we participated in two non-op projects for another 200 million. So all total five projects for about a billion two. So we had a great run, and one of the last projects we were getting into, and so that was my foray into oil and gas. So the beauty of that was because it was not a giant, E&P company, and we were, on the independent E&P side of the side. Had about 30 employees, but we had the full spectrum of services from the engineering to geology to land and all disciplines within oil and gas upstream. But because it was a smaller company, I was thrown into the middle of learning everything. And so
Mhm.
obviously I spent the beginning part of my time there wrapping my arms around the finances of the business and getting that structured in a proper way, and so that we could move forward with larger projects. And then we just began, as it is as a manager, it's all about talent, right? You're identifying where you need specific talent in the company, and so I started to bring in talent. My current partner, Jared Christensen, as I hired him at Petromax to run all of operations for us. And I actually took, when I went to another company after Petromax, he came over there with me as well. And then Jared and I decided to start Invito. So
Okay.
that was a great run. At Invito, the projects were getting really large for us when I was at Petromax. And we took private equity money, and they took us and two other portfolio companies and put us together and went public, and they kept one management team. And I had about a 2 year non compete to sit out, and then I jumped back in the space. And during that 2 years, I opened up a title
Okay.
company, opened up a software company, did a lot of stuff.
Okay. A title company.
Yeah,
I'm a minority owner of a title company, so there's some crossover there.
yeah,
Um, so
yeah.
you already said a couple of things that I know that we're going to want to dive into, but I'm trying to figure out. I think I even want to like stick with you personally for a minute. What what was your experience with alternative investing or passive investing before you actually started working with these entrepreneurs in the oil and gas field? Essentially running a company that was raising money and doing oil and gas. Did you have any experience in that beforehand, or was this like a totally new thing for you?
Very little in the sense of for my own personal portfolio, I was your typical executive in the sense that I was working a ton, handing
Hmm.
my money off to an advisor. And my personal journey there, right, was kind of the standard. You start out at a small, like you start out at the Northwestern Mutual in your 20s. I
Hmm.
moved on to Raymond James. And then when I went to Morgan Stanley, I went to Morgan Stanley because Morgan Stanley brought me into a hedge fund and a Blackstone private equity deal. So both those
Hmm.
would be all alternatives, right?
Okay.
So that was my first from an advisor standpoint where they brought me all options to get into alternative assets. And so that's why I left Raymond James and went over to Morgan Stanley. So other than that, I would just say startup VC, right? I started up a title company. I started up
Okay.
a software company. Those I don't know if you consider those alternative assets, but to some extent, when you invest in the
Yeah.
VCs, you're investing into startups. So, uh,
Yep, absolutely. Yeah, I always like to hear, personally, I've always been so real estate focused, and that's my group, right? The people I see the most, and so most people I know got into the alternative space through the single family investing route, right?
yeah,
Rich dad, poor dad, then into multifamily, and then from single family to multifamily, and then branching out from there. So it's always interesting to hear other people's paths that didn't start that way.
yeah, yeah.
Um,
And to add to that, when I was at Petromax, when I was the president there, one of the second asset we sold for $500 million, we
mhm,
took about $26 million and we 1031 that, and we put that into basically about 20 commercial real estate properties. And so all of those at the time were Family Dollar, Dollar Generals, and Walgreens. So I was in charge of basically making that all happen as well. So in a matter of like 4 months, I closed on 20 commercial real estate deals,
oh,
and so
that's nuts.
got exposure obviously to the real estate, commercial real estate side as well. That portfolio morphed over time into, we're into self a lot of self storage stuff as well as now as we divested some of the specifically, well, we got out of the Walgreens deal and we've got out of some of the Dollar Generals and Family Dollar properties. So,
Okay.
yeah, that was my
Okay.
exposure, I would say, prior to calling on an advisory world that's specifically focused on and running an alternative asset fund.
All right. So oil and gas is obviously what you do. That's what you're here to talk about. You've done that. You've also invested yourself in lots of different types of real estate. And what I want to talk about is kind of that overlap because there are some shared maybe benefits from oil and gas and real estate, right? There's like depreciation, and depreciation is very different. But also you were able to 1031. So at some level from oil and gas into real estate, but you can also do that in reverse, right?
Sure.
Depending on the type of real estate, but the type of oil and gas investment. Why don't you
Yes.
talk about oil and gas investing as a whole? Give us a 30,000 foot overview before we start getting into some of the weeds.
Yeah. I mean, I think, look, it's similar. I
It's a
explain it to
big
people like
question I
this.
just gave you.
Well, no, it's all right because, I mean, I have these conversations a lot, right? And most people are familiar if they've been in the alts. The most common form, as you know, is commercial real estate, right?
Mhm.
They may have started by doing some single family stuff themselves, and then maybe some short term rentals or whatever it may be, right? But at the end of the day, if you're if you're a fund manager and I'm running a multifamily fund, I'm raising capital and I'm putting that money into either, established multifamily properties, or I'm going to go do, a brand new build up, right? So one or the other, and the economics are based upon the rents, and as the rents come, you pass those along to the investors. So in oil and gas, the most common type of investment for retail clients is in the upstream side of the business.
Mhm.
So in oil and gas, right, you have upstream, downstream, midstream, right? So downstream is the refining companies that turn all the product into whether it's diesel, gas, all the different things it gets used for. Those are huge, companies down on the coast. And then the midstream is all the pipeline companies that are transporting the
Okay.
hydrocarbons around the United States. Those projects are typically not for retail clients because they're huge dollar projects, right? So the most common form of investment, direct investment, is to invest into wells. And so you
Okay.
can invest into wells in the form of what's called working interest, which is basically like equity in a building. That's what we call working interest. Working interest is the same thing as equity in a well. and you can invest in or into what's called royalty interest or
Okay.
mineral rights. Either one of those can be in wells that are already producing and cash flowing, or wells that have not been drilled yet, right? And so those are all, two different times: working interest or royalty interest. They could be either cash flowing already or non-cash flowing. And so there's kind of four different types that you can invest into. And so what we specifically do at Invito
Yeah.
is just purely invest into working interest
Okay.
into wells that have not been drilled yet. And if you're a working interest owner, the difference between working interest and royalty interest is if you are a working interest owner in a well, you are responsible for whatever your purport. Let's say you own 10% of a well, 10% working interest in a well. Well, you're responsible for 10% of the CapEx to drill and complete the well. You're responsible for your 10% of the operating costs on a monthly basis, and then you'll receive your 10% of the revenue. If you're a mineral owners do not pay CapEx and they don't pay monthly operating expenses. And so the way this works is, let's say that Jared Benson's family owned, a bunch of minerals out in East Texas or West
Hmm.
Texas. And an oil and gas company comes and says, "Hey, we want to lease your minerals because we're going to drill a well in this area, and you're the mineral rights owner." And let's just assume for ease, you own all of the mineral rights, which is typically not how it ever works. But let's just make this easy. They're going to say to you, "Okay, we're going to pay you. We're going to lease it from you for 3 to 5 years. We're going to pay you $1,000 an acre, and most importantly, we're going to give you a royalty rate for your minerals." And that royalty
Okay.
rate ranges from, low side typically 12 and a half to high side maybe 25%. But let's call it 20%. So now what happens in this is when the well gets drilled, you don't pay for the well to get drilled. You don't pay for the operating expenses. But let's say there's $1 million of revenue in 1 month. You're going to get $200,000 off the top. You get paid first.
20% of the gross revenue, or like the
20,
profit?
20% of the gross revenue. You pay
Oh.
no CapEx and you pay no operating expenses. So that's why minerals trade in a higher multiple typically, right? Because they don't pay the monthly operating expenses. They get paid first. They get paid right off the top. If there's $1
Hmm.
million of revenue off a well, 200,000, 20% of it is going to the royalty owners first.
Okay.
So the 800,000 comes over here to the working interest owners. The operator pays the monthly operating expenses, and then what's left over gets paid out to the working interest owners. And so that's how oil and gas, the finances work on oil and gas between royalty owners and working interest owners. And again, we specifically invest purely into working interest of wells that have not been drilled yet. And we do that because there's huge tax benefits specifically for that part of it. If only working interest into new wells is where you can get large upfront tax benefits. And so, but all of them are great ways to invest in oil and gas, but
Hmm.
that's what we focus on.
Okay. So even in a lot of people, we're talking about tax benefits as a big benefit of oil and gas investing, but really that's not the only option, because in royalties, right? Is there
Yeah.
any tax benefit in royalties, or is that just straight up income to an investor?
Yeah, you're going to get all of them are going to give you what's called the depletion allowance, or what's called the small producers exemption, essentially where about 15% of the cash flow passes through tax free. So there's always going to be a
Hmm.
component of it that will have tax efficiency to even the stream of cash flow that comes to you. So 15% will essentially be you only pay tax on 85% of the cash flow, which is nice.
Okay. Okay. Now tell me this: do y'all go and do you drill your own wells entirely, or are you partnering with other working ownership, working interest parties? Like, how does that work for you guys specifically?
Yeah. So my background is running companies where we were the operator of record. So every well that's drilled in the United States, there is an operator of record. The company who is the operator of record is the company who's got to lease up the minerals, who's got to file the permits to drill the well. Then
Hmm.
they arrange for all the vendors to come online to drill the well, complete the well, and then when the well's in operation, right, they're selling the barrels of oil or gas, and they're paying the monthly operating expenses, and they're paying the working interest owners, and they're paying the royalty owners. They're filing all the state taxes, doing all the compliance and regulatory, right? And so that's what my background is. Today, what we do as a fund, the majority of what we invest into is what's called non-op working interest. Just means we are acquiring working interest in wells where we're not the operator. So we
Okay.
do have a small operated position, but let's 90% or more of our funds will be into wells where we're not the operating company. Another company is operating the well. And there are reasons why we do that. But that's what we do today.
Okay, no, that's great. And I have a buddy who works at a small family office, but they do minerals pretty much exclusively. And
Yeah,
so he has kind of given me the quick overview of, I guess, of the non-operating working interest. Then there's, the operating working interest and the minerals. And
yeah,
sometimes I have to hear things a few times before they really settle in, right? And so
yeah,
that's a helpful. What you've said has helped me categorize what he told me. Okay, so you guys like the work you do working interest, but the non-operating side of that now, currently,
yeah,
where
yeah,
you used to actually be the operator of those.
yeah, yeah.
So,
I was the president of Petromax. We operated all of our projects.
okay.
Yeah, for the most
So,
part.
man, I've got all these questions floating around that hopefully some of our listeners do as well, and I'm going to throw some of them out and we'll just get to them as we get to them. But like, how are, new well locations decided on? How do you decide what operators that you choose to work with now that you're not the operator, right? Because you're kind of giving up some decision making power when you do that.
Yeah.
And then we'll also, so I want to hear that about you and what Envito does, and then we'll get into even like how investors should be processing things later. So how do
Yeah.
you make those super important decisions to what you do right now?
Yeah. So let me, here's how I'll explain that. So first off, oil and gas is an extremely technical business. So I'm going to, I'm not say dumb it down, but try to make it easier to understand for people that aren't in this space. But at the end of the day, I said to you
You need
that
to dumb it down for me too. Yeah.
we do non-op working issues. I said there are reasons for that. Okay. So what are the reasons we do that? Right. I would prefer to be the operator because I have control and I'm a control freak. And so I always want to have control. But for the fun that we do and how we do this, it makes more sense to be non-operated. And here's why. So when you're going to go drill a well, in terms of locations of wells, there's kind of three general categories. This is not a defined term in the oil and gas space, but for how I explain it to investors is there's tier one, tier two, and tier three locations. It's almost kind of like commercial real estate class A, class B, and class C space, right?
Mm-hmm.
And so here's the deal. If I'm looking at a tier three location, right, and I go look on a map and let's say, okay, here's where we're going to drill our well. And we look in do a 3 mile radius around there. On a tier three location, there are going to be no other wells drilled within 3 miles that work in the same exact formation and the same whatever we're trying to target, right? So the engineer might be going 5 miles away, 10 miles away to gather their data to determine what the well, what's going to cost, but more specifically, what the production curve is going to look like.
Okay.
And so the spectrum of returns, right, on a tier three location, and there's a lot of other things that go into this. It could be the type of rock you're drilling, whether it's conventional, unconventional, vertical, horizontal. Again, don't want to get too complicated, right? But at the end of the day, if I'm looking at a tier three location, I could have a spectrum of return that's literally dry hole, 0 to 4, 5, 6x, right?
Okay.
So, and anywhere in between, okay? If I'm looking at a tier two location and same location, 3 mile radius, I'm going to have maybe 4 or 5 data points, right? So, in other words, somebody has already drilled some wells within the vicinity of where we are at, right? So, when the engineer goes in, he now has some data that's closer in proximity to where he's drilling. So, we're more than likely eliminating dry hole prospects because
Okay.
the hydrocarbons are more than likely there, but you can still get certainly an uneconomical well, right?
Mm-hmm.
And or the probability of the predictions of the engineer, because everything you do in oil and gas is predictions. You're drilling holes into the ground, right? There's no exact science to that. So the engineers are always, so just as a side note, geologists tell you that there's hydrocarbons in the ground. Engineers tell you whether it's going to make you any money. So
Okay.
that's one general difference, right? Especially reservoir engineers, right? And so you're not going to drill a dry hole in a tier two probably, but you still could have an uneconomical well, and or the probability or the statistical variance on your predictions can still be pretty big because you only have 4 or 5 data points.
Mm-hmm.
If I move over to a tier one location, right, I am going to be looking at a 3 mile radius and I'm going to have, 8, 10, 12 dozen or more wells there. So I have now when the engineer goes in to do his do his work, his reservoir work, which is determining what's the well going to cost to drill, what's it going to cost to operate, but more importantly, what's the production curve look like? They have a lot of data. And so you're certainly eliminating dry holes other than for like mechanical failures.
Okay.
And you're not going to have uneconomical wells unless you just are terrible at doing reservoir engineering, right? And so you're kind of eliminating that downside. It doesn't guarantee the upside, and it costs a little bit more to get into those projects. But when you raise, why do we do this? Because when we raise money through RIAs, which is what we primarily do, financial advisors,
Yep.
their number one mandate is very simple to you: don't lose my client's money, right? They don't
Yep.
want to risk losing the relationship because they took 100 or 200 grand and put it into an alternative asset, oil and gas, and the client lost their money, right? And so if you're going to have a mandate to not lose money, your ability to take what we would call exploration risk is really limited. So you got to focus on tier one acreage.
Yep.
So if I'm going to focus on tier one acreage in today's market, the majority, 90% plus of that acreage is owned already because these basins have all matured. There's been a lot of consolidation in terms of companies buying other companies. And if I wanted to play in that space on any meaningful level, I'd have to go out and probably raise private equity money, raise a $500 million fund, go try to make a large acquisition, and then try to bolt on and either buy other companies and grow it and sell it to one of the majors and or take it public. But that's not what I'm doing, right? I'm investing for retail clients through advisors. And so we can target tier one acreage by acquiring what's called fractional working interest. So we could be buying 0.25% working interest, 10% working interest in a
Mm.
well. And so, and then it allows us to get diversification in the fund in terms of basin and also in terms of number of wells. Because the average well we've been invested to is mostly horizontal wells. They're $8 to $10 million a pop. And
Okay.
so, as the operator, you typically own at least 50%. More than likely, they own 60 to 70% of the well. And so, if it's a $10 million well and you own 70%, you need $7 million for one well, right?
Okay.
So you got to have a big fund if you're going to have diversification as an operator. So that's why we do what we do. So, but let's go back to my Petromax days. Every project we did started off as a tier three project. In other words, we were drilling the first wells. So
Okay.
we're going
Super
out,
exploratory. Like,
right? We're going out and we're doing all the geology work, man. They're mapping the entire area. They're getting the logs. They're doing, structure maps. They're doing cross sectional. They're determining, that's what the geologist's job is. Okay, here's what this formation looks like. Here's where it stretches to. Here's where it thins out. Here's where it's thick. Here's based
mhm.
upon all the logs. Here's where the oil's at. And then the engineers come in and say, okay, well, here's how you should design the well, how you should complete it, so on and so forth. And so, luckily for us at Petromax, while I was there, we had a good string of luck. We had some projects that worked really well. We had a couple smaller projects that didn't work very well, but we had 5 that did really well, right?
Mhm.
Um, but and it's normal for an oil and gas company to have capital being deployed to tier three, tier two, and tier one, right? Because if you're only doing tier one, you'll eventually run out of tier one locations, right? And again, so um, that's kind of how decisions are made. But for us, it's really a data game, right? We are going into areas where we know we're focused on this, 6, 7 basins that we like,
Mhm.
primarily oil basins. And then when we go into underwrite, we're looking for enough data so that when we can have a statistical confidence in our EURs, and then we plug it into a financial model and we see if it meets our minimum metrics. So we probably underwrite 50 deals a month, sometimes more than that. I think
Ooh,
last
yeah.
year we underwrote over 1,300 well level assets, but only about 10% of them pass. And so when we pass them, doesn't mean we can acquire them. Then we have to go try and acquire the deals. And so
Okay.
it's a lot of data management for us, and a lot of deal chasing. But if you're going to do a non-op strategy, we feel like deal flow is the most critical aspect to it, so that
Yep.
you don't have what's called deal bias. In other words, if I
Yeah, you don't have one reasonable deal in front of you that you're trying to figure out how to make work.
right, if I got a $25 million fund and here's where I'm going to put it, well, I mean, I got to believe in that fund. I got to believe in that prospect, right? And I'm going to tell everybody why it's great. And so, whereas we can be agnostic to basin and agnostic to deal. If it doesn't fit, we just move on. If it doesn't meet our
Okay.
metrics, we just move on. But deal flow is critical for the way we're doing it. Um, So does that help answer those questions?
Yes, no, that's great. And that actually leads me to another question, which you haven't really touched on. You kind of explained, you kind of gave a correlation with, multifamily apartments and stuff. So y'all are kind of like on the development side. You're drilling new wells.
Mhm.
I do know, and I haven't personally invested in this myself, but I do know there's guys who they basically rework existing wells.
Mhm.
So my question for you is, why did y'all's focus end up where it is? Is it a preference because you like the investment better, or is it this is my experience, this is my strong suit? Give me a little bit of like, hey, why do we do this over reworking existing wells, which maybe from the layperson's mind would be less risky? I'm putting that in air quotes, right?
Mostly because of scale and the size. If you're going to raise it, if you eventually want to have a $50 million fund, it would be pretty difficult. And if you want to grow beyond that to
Okay.
find enough inventory for just reworks, right? And so, and it's also doesn't have a lot of the upfront purchase price may not be tax deductible as well. So, because
Okay.
you might be buying a project or a field that's already got some cash flow to it, and that's not going to fall into the IDC categories and give you the big write off. So there's nothing wrong with that model, but you're not going to find large funds doing just purely the rework models. But there are
Okay.
guys that draw, and those vary, right? There you could be going into a project where you could be literally like, okay, I'm going to go buy this 30 well package. It's producing on average each well is producing on average 2 barrels a day, 1 barrel a day. We think we can go in and we can add value by going on, bringing in a workover rig, cleaning some stuff out,
Yep.
changing some of the production engineering, the lifting systems, and we can take that from 2 barrels a day to 5 barrels a day, right? Well, most of that is really a PDP play, production play. There's not going to be a
Okay.
significant amount of tax benefits associated with that. Now, there are other strategies where they're going into, and this is becoming more prevalent and will become more prevalent as time moves on.
Mm-hmm.
They're going back into they're called refracts, right? So they're going into wells that were what we would call Gen 1 frac jobs
Okay.
that were maybe fracked 10 years ago. And they're going to go back into the same well bore and re-stimulate the well bore with, you know, Gen 10 strategies, right? Because the technology and the way we've complete wells has, changed so much over the last decade and it continues to change. And so that's another strategy as well. But
Okay.
that's not what we do as well. We're purely going into targeting the wells, new wells to be drilled, so we can structure the fund to give the significant tax benefits up front to the clients, and then the cash flow and the return will come through the cash flow off the wells.
Okay. Okay. So I think maybe the last question. I always say last question, that I end up asking two or three more. Um, Last question as relates to how you select what you do. How do you decide on your operating partners? Like I assume that, I mean, that's going to be an enormous factor for you.
Yeah.
Uh, that's
Yeah.
probably, I don't know if that comes before or after determining if the well looks reasonable, right?
Yeah.
But tell me about how you guys select your partners that you work with.
Yeah. So first off, the oil and gas business is a small industry. So if when we're looking at a well prospect or a well package, whatever it may be, typically we're going to know who the operator is. If we don't know who the operator is, it won't be hard to dig around and find out. So first and foremost, when you're looking at in an area, right, you're going to be looking at the company and do they have they drilled already a bunch of wells? Remember, tier one, right? So if they have it, they're typically going to have drilled a bunch of wells in that area, or if they haven't, then that's a red flag, right?
Mm-hmm.
But the red flag is really twofold. It's balance sheet risk. If I'm telling you the average horizontal well is $8 to $10 million, and some of these wells now, because the technology is allowing 3 and 4 mile laterals to be drilled, and these wells are
Oh my
12,
gosh.
sometimes $15 million or higher, right? And so the balance sheet risk is simply we won't partner with a smaller company where we don't know where their capital comes from or that we'll feel confident in their balance sheet strength because we don't want to get into a project with them and then they don't have the money to drill the well. That would be a disaster for us. And
Mm-hmm.
so that's one. So we won't participate with smaller companies. If they're private equity backed, if they're a well-known large independent or they're public, it's easy to understand their cap. Or if you can see the historical track record of how many wells they've drilled, those are ways you can answer those questions. The second one is technical team risk, right? these are complicated. Some of these are really complicated projects. The deeper you're drilling and the longer you're going horizontally, the more technically difficult it is, right? And so you want a company that has a full suite of technical people that have learned lessons along the way and have already paid for the hard lessons, and or they're not poor boying it with maybe just one engineer trying to do everything,
Okay.
right? Because there are, inside the engineering side of the business, there's reservoir engineers, there's production engineers, there's drilling engineers, there's completion engineers. I mean, there's multiple disciplines within inside the industry, right? And so you're
Yeah, and
left.
those are all positions inside the oil and gas side of the industry. I know I was looking at I had a essentially a gold mine pitched to me, and was interesting, right? Some of the
Sure.
returns
Yeah.
can look really, really great.
Yeah.
Uh, and ended up flying out with a buddy, meeting the guy, taking a look at it, driving around Arizona, outside the Phoenix area, and a lot of the stuff you just said um, ended up being reasons why I didn't pull the trigger. My buddy didn't either. It was, they had like one old retired engineer that they had the guy's son. They had one project in their experience belt that, while maybe you couldn't say it was a total failure, it definitely wasn't a success. Basically, they had to shut down operations and were waiting for values to rise for something else they had done.
Yeah.
And I was asking a petroleum engineer friend of mine. I was like, "Hey, can you make any sense of these, like these studies that they're showing us from other from engineers in that field?" And he's like, "I really can't tell you much about gold formations,
Yeah.
but he's a super smart oil and gas guy. So,
Yeah.
yeah, interesting stuff.
It's the interesting part about it is that what's unique to oil and gas is the operator of record in oil and gas hardly ever owns 100% of the working interest. So there's this whole secondary market of non-op working interest that trades. And the
Mm-hmm.
opportunity there is, if you really think about it, like we just closed on an EOG package, right? EOG is a massive oil and gas publicly traded E&P company, right?
Yep.
Or you could put 50 grand into my fund, and your money is going into a well being drilled by EOG, who's already spent hundreds of millions of dollars in this area. And on each individual well, this particular well project that we're into, these three wells are $12.3 million a piece, right?
Man.
And your 50 grand gets to go into it.
Okay, so why does a company like EOG sell any of their interest?
Because they don't ever sell it to us. The operator of records never selling us their work interest. They could care less about us. Got to remember what I said. They rarely own 100%.
So from the get-go, they didn't own 100%.
Yeah.
And it's all the non-ops that are trading their interest in it.
Yep.
Got it.
So they own enough to control operations, which is at least over 50%, or whatever their numbers are, they own 60, 70% or whatever. And there are reasons for this, especially in states other than Texas, that have what's called forced pooling provisions, where an operator doesn't have to lease up all the mineral owners. And sometimes when you do title work, you're a real estate guy, right? So imagine going out and doing the title work on a 1280 section, and you're pulling that. There could be 50 owners, mineral owners. There could be 400 mineral owners, right? And so in the states that have what's called forced pooling provisions, you don't have to get everybody leased up to move forward with operations. You can force them all to participate. Well, all of that information is public record. So if you know how to get that information, you know how to use that information, you know how to underwrite that information. If you know how to go then target that for acquisition, it's a large database for lead gen, although it is a ton of work.
Oh yeah.
Ton of work. And, most people are not willing to chase down small deals for that the work that comes with that, to chase down all those small deals, is most people are not going to want to do that. But we've built a lot of systems around that. Then there are just other mineral owners that are other oil and gas companies, other mineral companies. A lot of stuff's held in trust, but a lot of times, it's these, think about these oil and gas companies, they acquire acreage, and sometimes their acreage crosses over. And so, hey, they own 10% working interest in a project of another E&P company. It's not their core area, and their CapEx is not allocated for that. So they'll lay off that working interest. And so you can acquire it that way as well.
Okay. All right. So we've spent a lot of time on kind of like the technical side of what you do, which I think is super helpful for a lot of listeners. But But there's also a pretty strong subset of people who don't care at all really about the details of the inner workings of what you do beyond how it benefits them. So what type of, maybe I'll give it this to you two ways, you answer it however you want. What type of investors um, most often benefit from oil and gas investments the most? Or what are the big benefits of investing in oil and gas over other types of alternative investments?
Okay, well, so first off, our offerings and most private placements are 506c offerings, right?
Mm-hmm.
So that you have to be an accredited investor, right? So you got to start there, right? Accredited investor definition for the SEC is if you're married, last 2 years of income is 300,000 or higher. If you're single, 200, or not or you have a net worth of $1 million minus the value of your home. So we could debate that whole rule, but because it does exclude people from getting access to a lot of alternative assets because they don't meet those minimums. But if you are an accredited investor, what I would say where this fits is I like to look at. Here's the way I look at this, man. You got to look at yourself and your own portfolio construction, right? And everybody's portfolio. You've heard the old 60/40. It used to be 60/40 stocks bonds, right? So that 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 allocation model is dead in a doornail, although I think some people still follow it, right? But that's literally excluding the entire alternative asset world, which is a large umbrella of different types of investments, right? So an alternative asset, let's just start there, right? Is anything that's really not a stock, bond, mutual funds, ETFs, things like that, right? And the biggest characteristic, a differentiator for the most part is most alts are not liquid, right?
Mm-hmm.
What is a stock? The biggest thing about stocks, they're liquid, right? You can be in and out same day, in and out, and 5 minutes later you can be out, right? You can always get your money out instantly. So most alts are not liquid assets, right? So that's a big differentiator. So part of the rules for the accreditation standards is, anybody looking at alts and an illiquid alt, which oil and gas would fall under that category, you have to make sure from a liquidity standpoint, you are not putting capital to work that you need or could need in any short-term future, right?
Mm-hmm.
So beyond that, it's really what are you trying to do? What do you feel like your mix of alternatives is of your own portfolio? 10%, 30%, whatever it is. And then you could carve out a piece of that alts for oil and gas. But I would say more specifically, because of the tax benefits, the investment thesis for oil and gas has a significant tax play at the front side of it. And so if you're not able to take advantage or benefit from those significant tax benefits, then maybe oil and gas for that particular year is not the right alternative mix for you, right? And so because it has a great upfront tax benefit, and then from there is doing what most alts do. It's an uncorrelated asset. In other words, it doesn't trade daily, so it's not tied to the stock market or the bond market. So you really have to think about this. Like, take 2022, take 2008, take the beginning of April, right? Right? Tariffs get thrown out there and the market crashed, right?
Mm-hmm.
So,
Well, yeah, 25% or something like
look,
that.
that's what alts do for you. They smooth out volatility in a portfolio. If you're, just to make it easy, if you had 50/50 liquids, liquid assets and alts, you're versus a guy who's 100% in alts or 100% in equities, the two of you felt totally different in the beginning of April. One guy's sweating it. One person's sweating it and stressed out all the get out because like their portfolio just has got hammered. And the other person is, part of it is, but the other part's retaining value, right?
Mm-hmm.
And so that's what alts do in a portfolio. One of the purposes they serve is to provide some volatility smoothing out because they aren't traded on a daily basis, right? And so that from there, you're trying to create what most people call alpha, right? So in other words, alpha is the benchmark of alpha is like if I just go put myself into an index fund that tracks the S&P 500. If I'm going to take a little more risk through an alt, and some of that risk is purely just because it's illiquid, you want to get a higher return, and that's what alpha is called, right? So if the S&P 500 is giving me 8 or 9%, then I'm looking for maybe 12 to 15% at a bare minimum for my alternatives or higher, right? And so depending on the asset class and how much risk, the risk adjusted return, right? So, and most of them create cash flow, but a lot of them are also just depends again where you are in your own personal journey, right? Are you in accumulation stage? Like, are you still trying to get to a certain level of assets so that you could be retire and or work optional? So maybe income isn't as important to you, but maybe overall return is more important to you. And again, these are things you look at when you're um, choosing certain alternative assets. But as you know, commercial real estate, what does commercial real estate do? Commercial real estate provides a stream of income,
Hmm.
and then it provides a multiple. Oil and gas is no different. And similar to commercial real estate, there can be significant tax benefits on the front side. They're just a lot easier to qualify for oil and gas than they
Yep.
are for commercial real estate. And so I think, I'll give my own personal journey. I'm on my own personal journey to get to like 50-50,
Okay.
right? I have, because remember what I told you, I was really just an executive handing my money over forever. Most of my portfolio, other than in some of those alts that I got into when I went over to Morgan Stanley, and I'm no longer with them as well, but I was heavily in equities, man. And so like 2022, I got hammered, right?
Mm.
And so, I'm 56 years old. The older you get, right? It's not, it takes, you lose 30% or lose 20% in an equity portfolio. You don't need 20% to get back to break even. It's not how, that's
Correct.
not how the math works.
Correct.
Most people don't realize that. So as I
A
move toward,
20% loss requires a 25% increase or something like that,
yeah, I
right?
mean,
To break even.
so as I move towards 60 and into that next stage, I certainly don't want to be waking up every day watching the stock market, right?
Yep.
As I construct my own portfolio for retirement. Although personally, I get asked all the time what my hobbies are, and I don't really have any. I don't think I'm ever going to retire. But
Yep.
I like the term work optional or work fluid in terms of work when I
Work,
want.
work fluid, yes, on a spectrum.
Yes.
All right. So we've talked a lot about the tax benefits. How much, as a percentage of someone's investment, let's say $100,000 is invested, what's the potential tax benefit for that individual? And I know
Yeah.
it'll vary based on their actual tax bracket, right? But
Well,
how is
not
that?
the tax benefit won't vary, but the return from that benefit will vary.
Yes. Okay. That better way to say it. Yes.
Yeah. And so everybody gets in oil and gas when the funds are structured correctly, any drilling fund will get the intangible drilling cost deduction, which is section 263C of the code, which essentially says that you can take 100% of the intangible drilling costs and deduct them in the year of investment. Or another way to say that is to depreciate it in the year of investment, right?
Mhm.
So an intangible drilling cost is defined by the IRS as anything that goes into the ground to drill a well that has no potential salvage value. That is typically low side 70, high side 85% of the total cost of a well. So a very, very average number is somewhere between 75 to 80% of your initial investment. If someone put in 100 grand, let's make the math easy. Someone put in 100 grand and the IDCs were 80%, they're going to have an 83,000 or an $80,000 loss show up on their year one K1 and it shows up on line 13, right? So that's where your IDC deduction will show up in your
Mhm.
initial K1. And so that $80,000 loss will flow through to your Schedule E and your 1040. And again, to make your math easy, let's say I had a $500,000 of taxable income after my AGI is a $500,000 after I've written everything else off. And now my $80,000 loss hits it. Now I have $420,000 of taxable income. And so that's a direct deduction of your taxable income. It's not a tax credit, right?
Yep.
Which is totally different.
Yes. Yes.
It's a tax offset of your AGI. And so you'll get
And
that
so
one.
one of the
Yep.
Go ahead.
No, go ahead.
So it's like, I want to make sure our listeners, understand the difference between this and real estate, because in real estate depreciation, um, all that paper loss can only be offset against passive
Passive.
gains or passive income, unless they qualify for, the real estate professional. So do I have to qualify?
What you can't do it
Correct.
a regular job.
Correct. So do I have to qualify as a real estate professional to get the tax benefit of an oil and gas investment?
No, that's the beauty of oil and gas. You just make the investment. So
So
let's compare it to commercial real estate. If it's a commercial real estate deal, and let's say my wife or your spouse is qualified as a real estate professional. First off, you have to document all that, and the IRS is paying attention to that, but let's assume you do. But then you also got to go out and get a cost seg study, right? If you want a big upfront write-off in year one, you got to go get the cost seg study, right? Which you can do. Or you can do short-term rentals, and that'll give you the ability to offset ordinary income instead of passive. Or you can do short-term rentals, but again, got to prove material participation. Of course, you got to manage the property, pick the property. Again, do a cost seg study, and then you could potentially use that loss to offset ordinary income as well. Otherwise, it's going to be stuck as passive losses to offset passive income. For oil and gas, the funds are structured as limited partnerships. The way that works till you get to offset ordinary income is you come in as a general partner. So if you come in as a GP, and then the conversion to GP to LP is automatic, it happens typically in year one. That's how you can offset that initial ordinary income. If you have a bunch of passive income, then you could come in as a limited partner and take the passive losses as well. And so you get the big IDC deduction up front. The remaining cost of the well, the tangible costs, which is just the opposite, anything that goes in the ground that has salvage value, pipe, casing, production equipment, 15 to 25% of the cost of the well. Typically, you amortize those over 7 years, right? But you can take bonus depreciation on those just like you can in every other industry. So you can accelerate those as well. And sometimes you can accelerate those in the initial year of investment. But the caveat for oil and gas to take bonus depreciation is that the wells have to be made capable of production. In other words, they have to be drilled.
In service. Yeah. It's kind of that in service verbiage.
They got to be drilled, right? So for a fund like that closes on December 31st, that's never going to happen. You can take bonus depreciation the following year. Like we always have an opportunity fund that we open earlier in the year, which we have right now, and that will take advantage of bonus depreciation. And with the anticipation of it going back to 100, I sit on the leadership council of the NSBA, so we get consistent regulatory updates. That's in the House bill, that's in the Senate bill, and it's retroactive in both. And that Senate bill is actually making it permanent. So I don't think there's any chance something doesn't get passed. And whatever gets passed, bonus depreciation is going back to 100% because that has bipartisan support. And so some of the other ones may not be like I think like R&D might not be retroactive. But with the anticipation of that, you can get like our opportunity fund that's open right now. We think we're going to be able to deliver a 90 to 95% loss for 2025, which
that's amazing.
The year end will only be 75 to 80. So, but that's how it works. So you can amortize the tangible costs or take as much, bonus depreciation as allowable. Today, that's 40%, right? The TCJA is sunsetting right now. But
So just to be super clear, for those high income earners, oil and gas tax benefits can straight up offset W-2 income, 1099 income, anything that classifies as earned income, or whatever their AGI or adjusted gross income on their 1040.
And that's why it's such a unique investment. It has that binary benefit. And here's the other part of this to understand is there's a lot of tax strategies out there, but a lot of them are what I would just say purely on the dirt. They're on the watch list of the IRS. Doesn't mean that they're not legal. It just means the IRS is going to look at them. And the IDC deduction for oil and gas has been around for decades. There's tons of case law. This is not something the IRS is targeting. It has very, very limited, if not audit risk. Versus if you go do like a conservation easement or some of these charitable strategies. I mean, look, the IRS, any of these strategies with multiples, the IRS is just flat out telling you they're going to look at it. And so you just have to be comfortable with that.
Yeah. Okay. So what is a reasonable investment return look like for someone like you, right? So if someone is interested in oil and gas and they're interested in what you are doing, what are the ranges that someone should expect? And it's always going to vary. No two deals are going to be the exact same, but what does that typically look like on a reasonable deal?
Yeah, look, I'll go back to what I said earlier. If you're going to invest in alts, you should be looking for alpha, right? Mm-hmm. Otherwise, just stick your money in an index fund, right? So if I'm going to invest in an alternative asset, like for us, we target a 15 to 20% annualized return when our investment's all said and done on the low side. right?
Yep.
There's obviously room for upside, especially because we're tied to commodity prices, but that's what we're targeting for a minimum. When we underwrite, if we can't get to those minimum returns, we pass, right? Because we feel like the risk adjusted return doesn't justify it, right?
Mm-hmm.
And let's leave the tax part of it out of it, because the tax part can complicate that decision a little bit, because that is a heck of a benefit that you get up front, and that is real money that you are saving. And then
Okay, so that was actually a question that I had. I know a lot of investors have. That 15 to 20% should be the actual ROI of your investment. You're not adding in the tax benefit and combining, and
yeah.
I don't know if inflating the ROI is the right word to use. But
I
when
mean,
you
look,
say 15 to
you can look
20,
at it both
that's
ways, right? But I think if you're going to if you're going to add, let's look at the total return. If you're going to add the tax benefits to it, you need to be conservative and maybe add a quarter basis point to that. So if I got a 2-to-1 return and 25 basis points of that was of tax returns, that tax benefits, that's fine, even if it was much higher than that. I just think from the upfront standpoint of an ad,
okay.
like, I think it's a double-edged sword for me. We like our projects are based upon cash on cash. Like, the way we make money and our carried interest in our funds significantly increases when we get people 100% of their investment back, has nothing to do with the tax benefits. But the tax benefits are real money. I mean,
Yeah.
when you stroke a check to the IRS, that money's gone, right? So if you save 50, 60, $75,000 on taxes, that's not only money you didn't write to the IRS, but it's also money you can turn around and reinvest into something else. So it's real money, but I think from a conservative standpoint, you should be very conservative in what you're including in that return profile. And then as far as we're concerned, when we're talking about metrics or back end waterfalls, we don't include the tax benefits.
That's good to know. Um, so before we wrap up, I want to talk about a few more things, specifically red flags in the oil and gas alternative space. So if an investor, maybe they invest with you and then they're also looking for some other guys and they start meeting guys at conferences, they see the guys speaking from the stage or they've got the booth. Give us a couple of red flags that investors should be looking out for when they're considering oil and gas.
I think that I think look, if you're coming into, here's the first thing I would tell you: if you're coming into an oil and gas deal and you're looking at it from a tax strategy standpoint, which most people are, when you're looking at deals that are talking about exits in 2 to 3 years, that is not a tax strategy deal. If you come into a deal in oil and gas and you turn around and sell it in 2 to 3 years, you're just giving the tax benefits right back through IDC recapture. Same thing as bonus depreciation recapture. That's why we will never sell before 5 years. Makes no sense. So I'll see a lot of guys pitching out of both sides of their mouth. This is a tax play, big write-off, and we're going to exit in 2 to 3 years with this multiple. Well, then don't talk to the people about tax benefits up front. That's like, it's already a tax deferral program, to be honest with you. But what's the point of 2 years or 3 years? That doesn't make any sense to me. So, if you're coming in from that perspective and that's what the exit is, you need to think hard about that one. Two, look, it's always the background of the team. I don't care what asset you're looking at. You have to look, and you need to do this to your due diligence yourself. Who are they? What is their oil and gas experience? Who's on their team? And those team members, what is their experience in oil and gas? Have they ever worked for other oil and gas companies? They ever worked for any of the major oil and gas companies? Are they technical people? Are any of them technical people? Are they geologists? Are they engineers? Are they land people? Do they have that part on their team? Are they more marketing people? Right. And so you want to avoid what I call promoted deals that are just being marketed to you. Right. And so if you get a phone call from somebody, that's a marketed deal. And the guy on the phone is probably making 8 to 10% off the investment. And so then you got to go read a PPM, and you're going to do this for every private placement you invest into. You need to understand the fees. The number one question you want to ask yourself on oil and gas is, how are they making money? How do they make money? And is it easy to understand? And can you go into the PPM and find it yourself? Okay. If those two things, if you can't answer yes to either one of those, then pass, right? Because I see complicated black box deals all day long, and it's hard to figure out what the hell they're doing. And I'm in the oil and gas space, and I can't figure out what they're doing, right? And so
Yes.
If you're coming into an IDC drilling fund because you're looking for tax benefits to invest into wells, it should be pretty freaking simple. Like their fees should be very black and white and disclosed, and that should tell you how much they're aligned with you.
Mm-hmm.
And then in terms of how you make money, it really shouldn't be complicated either. So those are
Yeah,
the
that's
four. And if you find deals, here's the other thing I can just tell anybody that are listening to this: if you get a deal pitched to you, and it's a 1, 2, 3 well deal, and it's a vertical play, and it's what's called a turnkey project where your working interest is guaranteed, don't do it.
what does working interest guaranteed mean?
So here it is. I come to you and I say, hey, Jared, I'm going to give you 10% in this one well. Here's what your working interest is. Here's how much it's going to cost you. There's no capital calls, and I guarantee you get that working interest. Well, the only way they can do that is by turnkeying the project to you. So in other words, let's say the well cost $1 million, right? Well, they're going to turnkey that to you. Typically, those deals are 50 to 100% promoted. So I'm going to turnkey that well to you at $2 million, right?
Mm-hmm.
Because I need to cover my butt, because what if the well costs more than that? And every well never costs exactly what you think it is. It could be under, it could be over. Sometimes if you have a problem, it could be way over. And so the only way I can guarantee your working interest is that I gotta have a substantial markup in my turnkey to you, in what's called the turnkey, so that I don't get caught. In other words, that if it really cost $1 million and that 10% is $100,000, and if I told you you're only paying me $100,000, what if the well cost $1.5 million? What if you have problems? You're eating it. Well, they're never going to do that. So in those projects, not only do they build margin to cover that risk, but they also build margin to make money. And so they're making their money in the turnkey as well.
Yep.
I'm just here to tell you, turnkey deals are always overly promoted. And so the biggest problem with oil and gas is the over promotion of projects. The fee structures are ridiculous on the front side, and sponsor bringing you the deal, in most cases, unfortunately, is making so much money on the front side, it does not matter whether or not the project's going to win or lose. And those projects typically are where they're hammering the tax benefits, and then they're also projecting ridiculous returns. And so,
yeah, I don't want to name any names, but I think we've both seen some paperwork where, I think when you talk to like how much money got spent on the guys raising money, I've seen that as high as 15%. So I invest $100,000, 15 grand of my $100,000 gets paid to fundraising, marketing, and stuff like that. And then when we've dug into some documentation, and you start taking out all the money that the general partner makes and how they charge, I'm trying to remember. I think it was as low as about 65% of the money actually invested went into the actual drilling of wells. And so
some extremely egregious deals, and typically the PPMs are hard to read and hard to figure it out as well. And so I just, the ones that are just promising big exits in the future, and or these 4, 5, 6x deals, I just, look, we're looking for 2x. So and that'll deliver somewhere between a 15, depending on when we exit, somewhere between a 15 to 20% return. There is upside because there could be higher commodity prices.
Yep.
But if you're betting on higher commodity prices for a project to work, that's the same thing when you get a prospectus on these deals and they say, oh, here's what it looks like at $80, $90, $100. All right. They're just trying to suck you in, man.
On the what ifs. Yeah.
Yeah. The what ifs. Oh God, if oil goes to $100, okay, well, look at a WTI chart and tell me when that's happened over the life of an asset, right? It doesn't happen. I mean, the last 10 years, if you take the last 10 year settlement price to depending on what date you start, it's around $65. You take the last 5 years, it's around 71 and change, right? Mm-hmm. You go 5 years from now and look back after Trump's gone, I guarantee you it's in the 60s. It's in the 60s. Could you get some periods where it's over that? Sure, you could, right? Could you we just had it, right? I mean, Israel bombs Iran, and all of a sudden oil's $77, right? They do a ceasefire, it drops right back down, right? And so you can get periods of some higher oil prices. Quite frankly, the United States economy can't sustain higher oil prices. It'll crush the economy if it's too low. And you can just look at a WTI chart yourself and see. that
Okay.
it doesn't stay there that long. So,
Yeah.
over promising stuff. The team just looks more like a promoter rather than actually oil and gas people. It's hard to understand how the valuations are happening, and you can't. The fees are hard to find in the PPM. You're having to read paragraphs all over the place, or following defined terms, or there's they sell they'll one of the common ways they do it is, well, turnkey's the one I've already explained, or
Mm-hmm.
they're they're buying the acreage in one entity, and then you'll read through the PPM or the partner or the operating agreements, and you'll see that entity is selling it to the fund at a market value. Well,
And then a different entity is drilling the well
yeah,
and charging,
and charging.
a margin on top of the
Yeah.
drilling cost.
And so
Yeah.
ambiguous language in PPMs drives me crazy, where they just basically, I just read a PPM for somebody, and it's in this particular PPM, it's the ambiguous language is literally everywhere, right? Where it just, well, you have no idea what that means. So they can charge whatever the hell they want to charge, and you won't even know it. And so I don't. You got to read PPMs, and PPMs are typically a lot of pages, but
A lot.
But here's the thing to remember: there's like 20 pages that matter. The rest of them are
Yep.
standard legal disclosures, and then you want to go read the operating agreement as well.
Mm-hmm.
And so you just got to read them. Unfortunately, these days you can drop them into Chat GPT and ask it to do the analysis for you.
Oh yeah, I love it. It's what you can't 100% rely on it, but it's like a really good assistant, right?
Great roadmap, right?
Yeah. Yeah. So. Okay. All right. Hey, as we start to get wrapped up, what is something you wish passive investors or people interested in oil and gas, what's one thing that you wish they understood a little bit better as they're considering oil and gas as an investment?
That's a great question. What they understood a little bit better.
And we can even rephrase that to, what's the biggest misconception that you frequently see when people are coming to you or hearing about you for the first time?
I would say for oil and gas, look, don't get lured into a deal because of the tax, and don't get lured into a deal because of outsized projections of returns. Is the first two things, right?
Okay.
And then you just have to do your homework. You have to take the time to read it. So if you put yourself on the other side of the table, unfortunately, what are some of the easiest ways to, if you're the person who's making a living, first off, if they're making a living by raising the money, that's the first problem, right? Mm-hmm. And so, and for those deals where the person on the phone or the company's making a significant amount of money on the front side, unfortunately, they say things that people want to hear, and outsized projections of returns, or minimizing the risk, that there is no risk, or almost acting like returns are guaranteed, are just things that you should never be saying in oil, in any investment, especially
in any investment. Yeah.
So you just got to think logically through it, right? And again, you're trying to chase alpha. So the smartest investors in the world are chasing alpha. And if you think you're Joe Smith and somehow you're going to find out how to get into 4, 5, 6x deals, I don't know. I guess you're better than all the money managers in the world.
Yeah. Yeah. Okay. Well, cool. Hey, Steve, you spent a lot of time with us. I super appreciate it. You did mention that it sounds like you currently have a fund you might be working with, or an opportunity fund. Tell us a little bit about that, and then the best way for someone to get a hold of you.
Yeah, so we do 2 funds a year. We do I'm not very creative. So the one's called the Opportunity Fund, the other one's called Drillco, and I just changed the year. Opportunity Fund 25 will close at the end of July, and then Drillco 2025 will open in August and go through the end of the year. The main difference is the opportunity is for the earlier fund is if you come in earlier, and we don't make it a very big fund, it's only a $5 million fund, we can put it into wells that'll get drilled this year, and then we can take advantage of bonus depreciation. So with the anticipation of it going back to 100 from 40, we think that we can deliver about a 90 to 95% write-off. The fund at the end of the year is only going to be 75 to 80. So pretty big difference, right? In terms of the deduction you will get. So that fund's open. It closes at the end of July, or when it's fully subscribed, whatever comes first. So, and you can just go to, invitoep.com, and there's a button up at the top that says current opportunities, and you can click on that and request access to the data room.
Okay.
And I think there's an email and a phone number on there as well. So, and you can find me anywhere. You can find me on LinkedIn, or, I'm
Steve
not
Blackwell.
hard to find.
Yeah, no, that's great. We'll put a link to your website in the show notes. Make sure people have access to that, and make sure that if someone's interested in oil and gas, I've known Steve for a couple years now.
Yeah,
great guy. He'll tell you the truth. He'll give you his opinion, whether you like it or not. But that's what I found is super valuable sometimes, is having someone who will tell you the truth, even if maybe it's not something that you wanted to hear, but just kind of cut through that bias that we all have, especially when it comes to things we want to do.
And we do have, if you go to YouTube and type in Vito EP, I have about 4 or 5 short videos on navigating oil and gas investing, which just talks about oil and gas investing, not about any of our funds. So that's good reading. I always tell people, if you can't go to sleep at night, turn me on talking about oil and gas, you'll fall right asleep. And then if you are interested, the path really is, when you get in contact, if you request access, we'll reach out to you. But the path really is that you and I will get on not you and me, but whoever wants. I'll get on I want to get on a Zoom with everybody, at least a 30-minute Zoom. And I want to walk them through how this works, how we manage risk. But the biggest thing I want to walk through is expectations, because I do not want partners and people in our funds that don't understand what they're getting into, because that turns into a nightmare. And so, and if they're not suitable for it, we won't accept the investment. So, so that's what will happen if anybody is listening. If you really are interested, you and I, us, will end up on a Zoom call together to go through this.
To be clear, the us is as you, the listener, who is interested with in talking with Steve. I will not be a part of those individual conversations. Yeah,
me and whoever is listening, and that they are interested.
yes. Yeah. So no, that's great. Steve, thank you so much for being here, and we appreciate it. This was great.
Yeah, always happy to do it. Good to see you, and hopefully it was helpful to some of your listeners.
Great, thanks, Steve.
Take care.
I know we got a bit more technical than I probably normally would like to do, but oil and gas is a confusing industry to be involved in. And I really think that it's important that you understand, at least at a rudimentary level, the things that you choose to invest in. So just a huge thank you to Steve for really diving in, helping us understand some of the different ways to invest in oil and gas, even though he doesn't do it those ways. So Steve was great. If this is something that you are looking at, if you are that high income earner that would love to be able to reduce your tax liability and passive depreciation doesn't work for you, then oil and gas non-tangible drilling credits could be a great option. So if you are looking for more information like this, check out the link for the passive investor event in October. Steve should be there. Steve's a great guy. I would love to see you there as well. And I will catch you on the next one.